In this week's update, US macro versus micro, a game changer of a week, and Bitcoin is on the rise again. My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information presented here is general advice only. Your personal circumstances, financial situation or needs have not been taken into consideration. Let's look first of all at the US micro situation. And for a long time now, the market has been responding in the short term to changes in the inflation outlook and therefore what the Fed would do with rates. Last week, things were looking pretty negative. We had a couple of hotter than expected inflation data points. The Fed was less likely to cut rates. In fact, there was even some chatter that the Fed's next move might have to be upwards rather than downwards. And a lot of stocks were starting to put in topping patterns or what could potentially be topping patterns. So last Sunday, things were looking pretty ordinary, I must say. But we've had an extraordinary week due to a couple of things. Some micro data points came in the other way, with inflation seemingly cooler than what had been previously indicated. But also there was a very significant change based around earnings, but I'll come back to that. So it was really a huge week in terms of change of sentiment for the market, and probably well justified. But getting back to the point, in the micro, so the short term, the focus on the day-to-day economic data, markets remain fixated on the Fed rate cycle and hence inflation. And so you're going to continue to see this flicking backwards and forwards depending on what the next data point shows. And that's an impossible situation for investors to try to negotiate if that's what you're using as your signal to either raise exposure, reduce exposure, change exposure. It's impossible to work that way. And the bond market is trying to predict the future, but we've got to recognize that the bond market is not a committee that sits around and decides that the 10-year yield should be at 5% or 4.5% or whatever the number is. So it's not parties making a decision about what they think should be. It's just all the various players acting in their own self-interest, as they always will. And if you ever really want to understand what moves the market, just think about it through the self-interest of the major players, and you'll be much, much closer to the mark. So the bond market has been or was selling bonds, which is pushing the yields up because it perceived that the Fed has made a policy error back in September last year in starting to cut rates. And that's just the consequence of the major bond players not seeing that holding bonds is attractive as it once was. So this impacts sentiment in the short and perhaps the medium term, unless, of course, and I talked about this last week, unless, of course, we're at a very long-term inflection point. You may recall last week I showed a chart of the long-term premium that the bond market is pricing into the 10-year yield. And it's possible that we are at a long-term inflection point. But I think for that to be sustained, particularly what has happened in the last week, the inflation would really need to pick up and be trending much more strongly than it is. So certainly the wheel has turned quite a bit in the last week. So what the last set of data points, and we had two data points during the week, is that headline inflation is still sticky. But if you look at the core inflation numbers, when you strip out, food and energy, that it definitely showed moderation. And this underscores the dilemma that the Fed has got about where to from here on rates. Which parts of the economic data do they overweight and which parts do they underweight? It's not an enviable job that they've got trying to anticipate what the economy is going to do over the next 12 to 18 months. So that's the US micro. And the way I sort of think about it is I can't anticipate it. certainly can't control it. It's too volatile to try to work with in a rational sense. So I just sort of largely ignore it, really. And again, as I hark back to last week, just focus on the stocks that are the best of the best, that are going to sail through, even in a higher rate environment, if that were to transpire. So just look for stocks where it doesn't really matter what the micro does, because it's too unpredictable and it's too volatile. So that's my approach to it. If we look at the US macro, though, and this is where we come back to why last week was a game changer, the one assured reality of stock markets is that long-term prices will follow earnings. And that earnings really starts, when you think about it, with higher levels of business confidence. Because with higher levels of business confidence, you get more investment in plant and equipment, more investment in people, more investment in technology. You just get a more positive can-do environment. And so business confidence is highly likely to lead to rising earnings, which of course then leads to stock prices going up in the long term. Now, the valuation multiples that the market is prepared to award a certain stock or a certain sector will fluctuate above and below fair value, whatever the hell that is. It's a bit of a smoke in the wind kind of concept, really, because it has so many assumptions embedded in it. But valuation multiples will fluctuate up and down as sentiment and the fundamentals shift. And a good yardstick that I could quote is and this is up until recently, when the multiple of Commonwealth Bank has just gone off into the stratosphere. But when things were poor for Aussie banks, they would typically trade on a PE multiple of somewhere around 9 or 10. And when things were going really well, they'd trade on a multiple of somewhere around 15, 16. Now, CBA has kind of blown that model out of the water, and that's why I think it's unsustainable. But that is just the market awarding different multiples according to how they see the future. So the valuation multiples will flick around, but long-term stock prices will follow earnings. So therefore, the obvious conclusion is you want to own stocks where the earnings are strongest and most assured. There's two things going together. So what's the best way to sharply raise your odds of success and hence your long-term return? Well, just focus on, as I say, just about every week, just focus on the stocks that have got two things. They've got a high probability of high growth being sustained well into the future. And that arises because of a whole lot of other precursors. But nevertheless, that's the area that you need to focus on. You can enhance your returns by then buying when those stocks are somewhat out of favour. They don't have to be right out of favour. They don't have to have been declining for 12 months, but just a bit out of favour, just to give yourself a bit of an edge to perhaps clear off some of the excess profit overhang that might be in the stock price. You can buy when stocks are high and still do well over the long term, but you won't do as well as if you're able to buy that stock after some sort of retracement. And the third thing, and this is really important, and this is what, in my experience in talking to traders and investors over 20 years, hardly anyone has any idea how to do this, to do it consistently and well. And that's know what your exit looks like if you need one. And you can do all this work in advance. You have no idea what price an exit for a stock might be in the future. But you can define what it looks like. It's a pretty simple task to do that. All right, now again, the message every week, it's just so easy to really stuff it up and lose money in the stock market. It's easier than putting yourself in a position to do well. So you've got to do your homework. You've got to be organised. And that's just the best way to be a successful investor. So just be mindful that you can suffer loss of funds. Let's look at the American market now. The S&P was up nearly 3% and the NASDAQ by 2.5%. So it was a very, very solid week. The Russell went up 4%. It's got a little bit of catching up to do, but 4% was a good start. We've still got mixed inflation signals. The week before last, we had 2 negative signals. Last week, we had 2 positive signals. Where does that leave us? It really leaves us nowhere if we're trying to use inflation signals as a means of guiding our investing. But what did change, as I mentioned earlier, is absolutely stellar bank earnings from JP Morgan, Citi, Wells Fargo, etc. Net interest margins were up. They all round, these were very solid results. And you know that they're very solid results when the world's biggest banks go up 6% in a session, in a single session. You know that the market is seeing something that it wasn't expecting and that they're applauding with their wallets. So for me, that is a game changer, because it may not guarantee that stocks in other sectors go up as well, but the next 2 weeks are going to be huge in America for earnings reports. But what it does do is put a floor under the US stock market. Given those bank earnings, I just cannot see the environment where the US stock market could come off significantly, like 20%. And there are plenty of people calling for that because of how they perceive the valuations. Using the Cape-Shiller model or whatever model they want to use, they've determined, because it fits their narrative, that the US market is so ridiculously overvalued that it has to fall. Well, I can tell you, when you get bank earnings like this and you get market responses like we've had, I just can't see any way that that's going to happen. So that means that doesn't guarantee that the stock you own won't go down, because many will. And it doesn't mean that the stock you own will necessarily go up. But what it does mean is the stocks that deserve to go up probably will, are highly likely to go up, because you've got an environment of stronger sentiment. This was the best week since the November election. And when I look at the charts in a minute, we'll have a look at the performance of US sectors since the Fed started cutting rates in September. So that's an interesting chart to look at. But it was a good, solid week, and the reason being is because of earnings. Energy was the big winner on the week, and consumer staples. And this is another reason why this is just not an environment where the US market is likely to correct 20%. If that was going to happen, the big players would sense it, they'd know it, they'd be reading the tea leaves, and money would be pouring into consumer staples. And consumer staples was the big loser. So this gives me a very different outlook to what I held last week, and also underscores the importance of being flexible in your thinking. Don't get wedded to a certain viewpoint and then find it difficult to back out because you've sort of committed yourself to it. Just remain flexible and go with what the market is telling you. The US dollar broke out a couple of weeks ago and is still holding that breakout at 109.5. The 10-year yield came off a bit, down to 4.63. You might recall it's only last week or the week before we were at 4.8. So that's a significant drop. And the VIX also fell back from around 1920 back to 16. All right, let's go and look at some charts. This is the S&P on a weekly basis. That's a really, really nice engulfing candle. We gapped down and then we traded up and closed on the highs, completely engulfing the previous week. From a purely technical point of view, that's a pretty solid sign. And we did it bouncing off the 20-week moving average or 200-day moving average. So that remains a very positive chart. There's the Russell, also very similar sort of formation. Has got more ground to catch up. But small caps certainly did much better in Australia, surprisingly well in Australia. The Nasdaq, not quite as good, but still that's a very, very positive trend. Semiconductors, always important, had a very good finish to the week. And now, if we look at the relative comparisons, these are US sectors since the first rate cut in September last year. We'll look at the laggards first of all. XLV is at the bottom, so that's healthcare. And it's been trending down ever since the start of the rate cut cycle. I don't have an explanation for that, and some parts of it are doing well. If you actually look at a subsector like medical devices, for instance, there's many stocks in the medical devices sector that are doing extremely well. But healthcare as a whole is lower than September last year and trending down. We've also got XLP, so staples. Staples went up a little bit initially with the rate cut, but since then it's been trending down and is below the point that it was at 4 or 5 months ago. Next, we've got materials. Now, materials had a pickup during the week, but again is one that has pretty much trended down since the rate cut cycle. Energy has picked up in the last couple of weeks as the price of oil has risen. It's been a bit of a roller coaster. We went up and then we went down very steeply, and now we're recovering very steeply. So that's really just reflecting fairly large moves in the oil price. The finance sector, the banking sector, obviously picked up strongly last week. It was doing okay before last week, but it was like the market was in limbo waiting for the next quarterly results. Next up the leaderboard is technology. XLK, we're above where we were at the start. It's been a bit of a roller coaster, and obviously of late we've seen some selling pressure because of the bond yields going up. So it's sort of kept the lid on technology. And then at the top of the tree, we've got communication services and consumer discretionary. And again, when you've got a market where consumer discretionary is at the top and consumer staples is at the bottom, this is not a market that's about to fall over. It just doesn't work that way. Now, we've had a dip, obviously, since the last couple of weeks of December, but last week was definitely a significant turnaround. Now, just while I'm here, let's look at Australia. So over the last fortnight, materials have really bounced back, and so is energy. And then we've got small caps also making a very rapid recovery. And a lot of that, if we put that on a weekly chart, a lot of that has happened in the last week. So the strongest sector, or the strongest part of the Australian market was XSO, or the small caps, followed by materials. Finance was strong on the back of the US bank results initially, but certainly some air came out of those tyres on Friday. Now, let's just have a look at the currencies. This US dollar weekly chart, so well and truly broken out 3 or 4 weeks ago, and it's still holding that. The Australian dollar, we broke down last week. I talked about that. We managed to steady a little bit, but closed well off the highs. And you have to say, just looking at that chart, that the direction is down. The momentum is to the downside. All right, that's the US market. Aussie Stocks, 6139 is where we finished. And that is just such an important level. And there's nothing really there that's indicating yet that it's going to bounce. Our index ended up flat for the week with materials, energy, and small caps, all making resurgences. Turning now to precious metals, gold was up 10 to 2,700. If we translate that to Australian dollars, it's almost 4,400. More to say on that in a minute. Silver comfortably back above the 30 mark at 31.23. And if we look at gold stocks, we've certainly got some improving local trends. They're still well short of what it should be. And I spoke to the multiples around Northern Star last week. I'll show you a couple of individual charts because I'm not sure that the gold sector ETFs actually reflect what's going on. So let's look at a couple of the Australian majors rather than look at the Australian listed GDX. So this is Northern Star. Now, we're almost at all-time highs. We're at pretty much the highs that were achieved in November of 2020, since it's a weekly chart. So the share price is doing pretty well. But given the gold environment, if you look at where the gold price was back in 2020 to where it is now, this should be doing a lot better. And the multiple the stock trades on would also suggest that they should be doing a lot better. So I'm expecting that when we roll into the Australian reporting season in February, that we're going to see some significant adjustments. So that's Northern Star. Let's look at Evolution Mining. These aren't recommendations, of course, but just an observation, basically, of what is. And if we put that on a weekly chart, it's improving, but we're still below the 2020 all-time highs. We've still got a way to go. We've got a trend. But given what gold is doing in Australian dollars, I just can't help feeling the best is still yet to come in these areas. So let's look at the gold price. So that was the gold price on a weekly in US dollars, and that is what it looks like in Australian dollars. Now, Bitcoin is next. And I've spoken about Bitcoin on a number of occasions, and how my view of Bitcoin has shifted in the last year or more, because I've seen the demand side. I'm far more comfortable now that the demand side is going to be not only sustained, but it's going to accelerate. There's just more and more evidence that that is the case, that the major players are really taking this on board, and there is so many different options. So there's the Bitcoin price. The all-time highs were set in the middle of December last year. Trump comes into the White House tomorrow. I can't see that that's going to have, it can only have a positive effect, I would think, unless the establishment somehow manages to slow down any positive regulations around Bitcoin. I don't know whether they can or not. That, to me, is perhaps the only risk to Bitcoin, is that the establishment just gets in the way, and even Trump can't clear the way fast enough. But there's certainly no question Bitcoin is looking pretty strong. So 104,500 in US dollars. If we put that into Aussie dollars, it's about 167,000. Now, if we look at other commodities, copper was at 433, which was pretty much unchanged from last week. Nickel was up a little bit. My take on it is it was just really a week where the market was looking elsewhere. That was pretty much it. And crude oil took another step upwards as well to 78. So wrapping it up, 2025 is a year where I think you've got to be really flexible and decisive, and those two things aren't all that easy if you don't have a really clear plan and you're really confident about what you do. You got to be flexible because you've got to have the confidence to shift your position as the environment shifts, and I promise you that it will. It'll shift and it'll shift back, and it'll probably do it a few times. So don't get locked into a certain thinking. And then also importantly with that is, if you've got a signal, if you've got evidence from the market that things are changing, then you just got to be decisive and do whatever needs to be done. So I'm expecting many abrupt curveballs during 2025, but that's fine, because from my perspective, that just creates opportunity. You get to buy things that are really, really good for the long term. You get to buy them a bit cheaper than what otherwise might have been the case. I just pose this question for everybody. Do you really know how to build a portfolio and a plan that's suitable for you, that can accommodate what is coming and what is likely? In my experience, the answer most people would have to give to that is no. and then just kind of stick their head in the sand and hope it doesn't become important. I can assure you it's really, really important, and it's going to get more and more important. So do whatever you need to do to get that part of your investing right, because if you don't do that, if you don't pay attention to it, then your investing is absolutely nowhere. Now, portfolio analyst this week coming is going to be, amongst other things, the normal question and answer and some other interesting education, is going to be an update on something which could be truly amazing. I'll just leave it at that. So if you haven't tried portfolio analyst before, it was a $1 trial for a 14-day period. I think you might see something extremely eye-opening. All right, that's it for this week. There's the email address and website, and I'll be back with you next Sunday. Cheers.